Let's bring in Oliver Sloup, Blue Line Futures. He's located in Chicago. Oliver, I know you and I were talking during the break there about some of these market moves that we're seeing, and you said you were actually looking a little over the horizon here when it comes to the corn market right now. What are you seeing out there?
Absolutely. We all know that the input costs for corn have been going through the roof and to the moon, essentially, especially that fertilizer market. And that's got the DEES 22 contract making new contract highs, and I wouldn't be surprised to see that momentum continue so long as the input costs continue to rise as well. Looking a little bit shorter term, the corn market looks really constructive, and this has started over the last 2 or so weeks. We've started to mark higher lows and higher highs. And last week's USDA report kind of confirmed the better technical landscape that we're seeing as well. We had every reason to break the market, in my opinion, and sell off, and we couldn't. So if you can't break the market on a bearish USDA report, that's what we would consider a fundamental rejection. And now you're seeing the market work back to the upside. There's a lot of significant resistance from 545 to 553, including a 100-day moving average, Fibonacci retracement, kind of the peak at the end of August, as well as that psychologically significant 550. Bulls can chew through this pocket. That could spark another wave higher, despite the harvest continuing to come in better than expected in a lot of areas.
Yeah, a lot of concern over the fertilizer shortage coming up next year, at least as things stand right now. And there's a lot of debate over how much that could impact the acreage. Now, you talked about what's driving the corn. If you look at soybeans now, are they looking at the exact opposite dynamics at work that's working on that market? What's good for the corn is bad for the soybeans right now?
Well, I think that's part of it. We've gotten some chatter here over the weekend that we could start to see the trade rhetoric pick up between the U.S. and China in the coming weeks and potentially more tariffs down the road. China is in Golden Week for much of the week, so the news wires for China might be relatively quiet, and that includes flash sales, so that might be suppressing prices a little bit more as well. But from the fundamental and technical aspect, I think there might be a decent opportunity down here. We made new lows for the move, taking out those June 17th lows at about 1240.5. We tripped stops below their overnight trade at 1235. And we're able to rebound a little bit, which is constructive, and I think, again, represents a good risk-reward opportunity. If we can defend those overnight, early morning lows, I think there's risk side at these levels, and we could start to see some short covering. Funds only net long about 57,000 contracts. So if we get a bullish catalyst in beans, the funds and managed money, they've got room to add to this market and could potentially take us back towards that psychologically significant $13 handle.
Soybean meal is a little weaker today. Soybean oil just a little firmer. December up 56 points now. We'll come back in just a moment. We'll take a look at our cattle and hog markets here on a Monday right after this.